Hi friends, today we will speak about the basic concept of bank lending. The roots of lending can be traced back to the roots of civilization itself. Written loan contracts are more than 3000 years old. They showed the development of a credit system that included the concept of interest. Loans are very simple contracts where one person lends something to another with the promise that it will be repaid in the future. The borrower suddenly has wealth, while the lender takes current wealth and places it in the contractual equivalent of a time machine in order to transfer it to a future date when he might better use it. For doing so, the lender is compensated with interest that makes him better off than in the present. In the 14th century, according to scholars, the medieval poem describes life itself as a loan from God and death as its final repayment. French scholars considered lenders as sellers of time that acted oppositely to natural law. For almost a millennium, loans were considered unholy. The Roman Catholic Church fawned upon the taking of interest during the 13th to the 18th centuries. In the recent time, lending is productive to society, and this fact has been made increasingly clear over the centuries. By choosing to whom he will lend money, a lender determines which projects he will help to bring into existence and which individuals he will provide with opportunities. Loans are fruitful and enable borrowers to improve their lives, to produce new goods and services. The lenders makes a profit and the borrowers gets to use capital, whether for consumption or investment purpose, that he otherwise would not be able to use. Friends, do you know that the Indian banking system consists of an apex bank, that is RBI, Reserve Bank of India, and other scheduled banks who follow the rules given by RBI. A scheduled banker gets money from the savings of the individuals and the borrowing he makes from the RBI. When Reserve Bank of India lends money to the commercial banks, the rate of interest it charges for lending is known as a bank rate. The rate at which commercial banks make funds available to people is known as lending rate. The lending rates also vary depending upon the nature of loans and advances. However, the Reserve Bank of India from time to time announces changes in the interest rate structure to regulate the lending of funds by banks. There are basically 4 types of loans given by banks. They are direct loans, the cash credits, the overdrafts and the discounting of bills. The direct loans are further classified into 2 parts, demand loans and the term loans. Let's study these types one by one. A demand loan is a loan which is repayable on demand by the bank. In other words, it is repayable at a short notice. The entire amount of demand loan is disbursed at one time and the borrower has to pay interest on it. The borrower can repay the loan either in lump sum or as agreed with the bank. Such loans are normally granted by banks against security. The security may include material or goods in stock, shares of companies or any other assets. Demand loans are raised normally for working capital purposes like purchase of raw material, making payment of short-term liabilities. Term loans. Medium and long-term loans are called as term loans. Term loans are granted for more than a year and repayment of such loans is spread over a longer period. The repayment is generally made in suitable installments of a fixed amount. Term loan is required for purpose of starting a new business activity, renovation, modernization, expansion of existing units, purchase of plant and machinery, purchase of land for setting up of a factory, construction of a factory building, or purchase of other immovable assets. These loans are generally secured against the mortgage of land, plant and machinery, building, etc. Cash credit. Cash credit is a flexible system of lending under which the borrower has the option to withdraw the funds as and when required and to the extent of his needs. The cash credit limit is based on the borrower's needs and as agreed with the bank. Cash credit is a secured loan. Overdraft. Overdraft facility is more or less similar to cash credit facility. It is granted only to the current account holders. Overdraft facility is the result of an agreement with the bank, by which a current account holder is allowed to draw over and above the credit balance in the account. It is a short period facility. The customer is permitted to withdraw the amount of overdraft allowed as and when it is needed and repays it through deposits in the account. Overdraft facility is generally granted by a bank on the basis of a written request by the customer. It is an unsecured loan. Discounting of bills. Apart from sanctioning loans and advances, discounting of bills of exchange by bank is another way of making funds available to the customers. Bills of exchange are negotiable instruments which enable debtors to discharge their obligation to the creditors. Such bills of exchange arise out of the commercial transactions, both in inland trade and foreign trade. The seller can discount this bill and generate ready cash. The bank collects money from the drawee of the bill in case the bill is dishonored on due date. The amount due on bill together with interest and other charges is debited by the bank to the customer's account. In recent times, the concept of lending has included many modern concepts like peer-to-peer lending. P2P loans are loans made by individuals and investors. People with extra money offer to lend money to others, that is, individuals and businesses in need of cash. Crowdfunding. It is sometimes called as online financing. It is a new way of individuals and businesses to fund projects and products by using the power of internet. Crowdfunding has been used by many years by the entertainment industry. Borrowing from families. This refers to the loans taken from friends, relatives and business associates. The interest rates, period of loan and the repayment schedules are decided as per the requirement of the borrower. Now friends, let's learn the basic principle of a sound lending. While deploying funds as loans and advances, banks should ensure that certain lending principles are followed by them. Banks should give importance to the principles of lending based on the concepts like safety, liquidity, purpose, diversity, security and profitability. Banks should also ensure that a good credit monitoring system is in place, both at the pre-sanction and the post-sanction levels. Friends, let's now discuss the principles of sound lending in detail. Safety. As the bank lends the funds entrusted to it by the depositors. The first and the foremost principle of lending is to ensure the safety of the funds lent. The repayment of the loans depend upon the borrower's capacity to pay and willingness to pay. So, if he earns profits, he can repay the loan promptly. Otherwise, the loan is recovered out of sale proceeds of his tangible assets. The banker should give a loan to a person of integrity, good character and reputation. Liquidity. Bank essentially gives loans for short-term requirements. Therefore, they lend funds for short period and mainly for working capital purposes. The loans are therefore largely payable on demand. The banker must ensure that the borrower is able to repay the loan on demand or within a short period. Assets like land and building, equipments, goods and commodities which are easily marketable are treated as securities for taking a loan. Profitability. Commercial banks are profit earning institutions. The nationalized banks are no exception to this. They must employ their funds profitably so as to earn sufficient income out of which to pay interest to the depositors, salaries to staff and to meet various other expenses, and also distribute dividends to the shareholders. The rates of interest charged by banks were primarily dependent on the directives issued by the Reserve Bank of India. Now the banks are free to determine their own rates of interest on advances. The sound principles of lending is not to sacrifice safety or liquidity for the sake of higher profitability. That is to say that the banks should not grant advances to unsound parties with doubtful repaying capacity, even if they are ready to pay a higher rate of interest. Purpose of loan. While lending his funds, the banker inquires about the borrower, the purpose for which he seeks the loan. Banks do not grant loans for each and every purpose. They ensure the safety and liquidity of their funds by granting loans for productive purposes only. Principle of diversification of risk. This is also a basic principle of sound lending. A prudent banker always tries to select the borrower very carefully and takes tangible assets as securities to safeguard his interest. Tangible assets are valuable and the banker feels safe while granting advances on the security of such assets. Yet, some risk is always involved. Principle of security. The security offered by a borrower for an advance is like insurance to the banker. It serves as safety value for an unforeseen emergency. So, another principle of sound lending is the security of lending. The security offered may be a land and building, flat, insurance policies, term deposits, etc. Before giving the loan, the banker has to check the creditworthiness of the customer, as the business of sanctioning unsecured advances is comparatively more risky and needs special care and attention on the part of the banker. In the absence of a charge over any specific asset, the safety of advance depends upon the honesty and integrity of the borrower. The banker has therefore to make proper inquiries not only about the borrower's capacity to pay, but also about the willingness to pay the amount. Though such inquiry is also necessary in case of a secured advance, but its urgency is greater in case of an unsecured advance. The creditworthiness of a person means that he deserves a certain amount of credit, which may safely be granted to him. Such creditworthiness is judged by the banker on the basis of his character, capacity and capital. Let us look at these categories for judging the creditworthiness of a customer in detail. Character. In assessing the creditworthiness of a person, the first consideration is the person's character. The word character implies and includes a number of personal characteristics of a person. Example, his honesty, integrity, regularity, promptness in fulfilling his promises, repaying his dues, sense of responsibility, good habits, the reputation and the goodwill which he enjoys in the eyes of others. If the person possesses all these qualities without any doubt or suspicion in the minds of others, he will be considered credit worthy by the banker. Capacity. The success of an enterprise largely depends upon the ability, competence and experience of the entrepreneur. If the borrower possesses necessary technical skills, managerial ability and experience to run a particular industry or trade, success of such unit may be taken for granted and the banker will consider him a deserving case for granting an advance. The significance of this factor is now growing as the banks are willing to grant unsecured loans to technicians and competent persons on the basis of soundness of their business projects. Capital. Banks are repositories of the public money and they lend the borrowed money. The banker, therefore, does not lend money to a businessman who does not have adequate funds of his own, because in case of failure of the business enterprise, the banker will be able to realize his money if the borrower's own capital is sufficient. Though the mentioned factors are important and taken into account by the banker at the time of assessing the credit worthiness of the borrower, their relative importance differs from banker to banker and from borrower to borrower. The consideration of security is now undergoing a change. Greater emphasis is being laid on the ability and competence of the borrower and soundness of his project. However, persons of doubtful integrity and without good character are not granted unsecured advances. Further, creditworthiness is a relative term. So, the loan sanction amounts differs from person to person. For collecting the information about the customer, the banker has to collect the information from a number of sources. Every bank maintains a credit investigation department at its head office and main office in large cities to collect information regarding the financial position of its borrowers. At other centers, credit investigation is performed by branch managers. Credit Information Bureau. The Reserve Bank of India has established within itself a Credit Information Bureau which collects credit information from the banks. Banks are required to furnish such credit information in respect of credit limits of 5 lakhs and above in case of secured advances and 1 lakh and above in case of unsecured advances. They mention the nature of facility, security and charge along with outstanding balance. After consolidating such information in respect of each customer, the Reserve Bank of India supplies the information to the applicant bank relating to the total limits, sanctioned and the number of banks dealing with the party. Thus, the bank can find out if any of their customers is having excessive borrowings from the banking system at any particular time. Such information can be secured only in respect of big customers. Hence, the bureau is of limited assistance to the bank. Borrower. Much information may be secured from the borrower directly. The loan application form seeks basic information about the borrower and his business. The banker may examine his account books and note his past dealings with other banks or parties. His passbook with other banks can show his dealings and the business undertaken in the past. The personal interview with the borrower will also enable the banker to get a clear picture of a state of affairs. Bazaar reports. Banks try to find out creditworthiness of the party by making inquiries from the brokers, traders and businessmen in the same trade or industry. Their individual opinions may differ, but a balanced opinion may be formed about the borrower on the basis of the feelings expressed by a number of such persons. Exchange of credit information amongst banks. It is a practice and customary usage amongst banks to exchange credit information relating to the constituents in their mutual interest. But the credit reports exchanged by banks are brief and superficial. They are in general and guarded terms. Banks are reluctant to exchange meaningful credit information because they feel that legal protection available to them will be lost if more facts are revealed to the inquiring banks. Balance sheet and profit and loss account. An analysis of the balance sheet and profit and loss account of the borrower for the last few years will reveal his true financial position. These statements should be certified by competent accountants. Now friends, let's talk about NPAs, non-performing assets. NPAs result from bad loans or defaults. Default in financial terms is the failure to meet financial obligations, say non-payment of loan installments. Thus, to avoid bad loans, banks should basically follow the principles of sound lending. Now friends, let's see some practical situations. Mr. Joshi wanted to get a loan of rupees 10 lakhs. The bank checked the asset standing of Mr. Joshi. But from the research, it was clear that Mr. Joshi has assets worth rupees 8 lakhs. But Mr. Joshi's company had a good market share and a considerable goodwill in the market. But the banker still grants a loan of rupees 10 lakhs. Now the question arises, can a loan be granted on the basis of goodwill? And has the banker followed the principles of sound lending? Let's analyze the situation. The customer has approached a bank for getting a loan. This customer has a very good name in the market and so has a considerable goodwill. But the assets which are available as mortgageable property are lesser than the amount of loan he has demanded from the bank. But still, the banker has granted him a loan. The solution to the questions may be, the banker has granted a loan, but the banker does not have enough assets taken as mortgage. Thus, the banker has granted a loan against intangible asset, that is goodwill. If this loan becomes bad loan, then it will be the fault of the banker. Loan cannot be granted against the basis of goodwill. And so we can derive from the situation that the banker has not followed the principles of sound lending. Let's take another situation. Mr. Sheikh wanted to get a loan of rupees 20 lakhs. He also knew that a collateral security more than the loan amount demanded has to be provided. Thus, he purchased substandard machines and labeled them with branded names. He also asked the friend to remain as a guarantor. The banker gave a loan on the basis of the shown facts. Now the question is, can a loan be granted on the basis of substandard material? Has the banker followed the principles of sound lending? Let's analyze the situation. A customer, Mr. Sheikh, has approached the bank for getting a loan. The machines which were presented for mortgage are tempered by him. But the banker did not conduct a proper check before granting a loan. Answer to the question, the banker has granted a loan on substandard assets. as the banker did not conduct a proper check of assets presented for mortgage. This is a misconduct on the part of the customer, but also a fault of the banker. Thus, if a loan turns to be bad, then the banker will suffer losses as the mortgaged machines cannot earn any money from the banker. Thus, a loan cannot be given on substandard assets, and in this case, principles of sound lending have not been followed. Let us take another condition. A cardboard box manufacturing company took a cash credit loan from a bank. The stock was mortgaged with the banker. The client, that is the cardboard box manufacturing company, utilized the entire amount of cash credit loan. At the end of the year, the client declared that the stock was burnt in the fire accident in the factory. So, he cannot repay the cash credit loan. Now, the question arises that can a cash credit loan be granted only on the basis of stock as mortgageable property? Did the bank follow the principles of sound lending? Let us analyze the situation. The customer has approached the bank for getting a cash credit loan. The banker mortgaged only stock and granted a loan to the cardboard box manufacturer. The customer utilized the entire cash credit loan throughout the year, but at the time of repayment of the entire cash credit loan, the customer declared that he was insolvent and could not repay the loan. The stock was destroyed due to the fire in the warehouse. Thus, the loan becomes a bad loan. Solution for the questions. The banker had granted a loan only on the basis of stock, which is a current asset. The banker did not take any fixed asset as a mortgageable property. Further, the insurance on the stock was also not properly checked by the banker. Thus, the banker is facing a loss as the basic principle of sound lending have not been followed. Now friends, we can thus conclude that for reducing the number of bad loans, it is very essential that the banker should strictly follow the principles of sound lending. Thank you friends for being patient listeners. Bye friends.